Welcome back for more on our top line story and for his take on the oil market as well. We're joined by our featured guest of the morning. He's Ryan Bushell, President and Portfolio Manager at Newhaven Asset Management. Thanks for coming in.
Thanks for having me.
Your quick take on the Teck Resources situation. One of the takeaways here appears to be that a controlling shareholder, the Keevil family in this case, can't simply say no forever if shareholders want them to engage with a potential suitor.
Yeah, and it speaks to, again, how badly Glencore wants to purchase Teck. And it's kind of one of the themes we've been talking about is when you think about Teck, you think about copper. Copper resources worldwide are getting harder to find. They're getting more expensive to develop. And the inflection in copper investment because of the investment in electrification worldwide is inflecting higher rapidly. I read something the other day that just the investment into copper over the next decade is about $250 billion expected, and that's the market cap of Rio Tinto and BHP combined, so two of the biggest miners in the world. So when you think about that, you're looking at, where are the copper assets that can be bought? And so yes, the Keevil family, I think, is, for my purposes as a Canadian, doing the right thing. They want to keep the asset in Canada, but at a certain point, shareholders deserve the best deal.
Do you like the copper stocks right now in terms of valuation and opportunity?
I think there is a lot of opportunity for our clients. We find the commodity, the raw commodity, too risky. We tend to like to invest in the infrastructure that supports the electrification, distribution utilities, natural gas infrastructure, renewables, things of that nature. Teck's gone bankrupt or nearly gone bankrupt twice in my career. My career is not super long. It's gone to $3 twice, so it shows the volatility of those commodity cycles. But I do think the game is changing, and going forward, this is an attractive asset, and that's clearly what Glencore thinks as well.
Okay, let's bring up a one-year graph of the price of oil, and let's begin talking about oil and why prices seem to be so stubbornly low. There you see like a bouncing ball that bounces lower and lower with every bounce, despite the fact that Saudi Arabia has done a lot of job owning, to use a phrase, and cutting production as well.
Yeah, so, this is we're just getting into the seasonally strong period for oil demand. Prices usually forecast that forward. So usually in the spring, prices start to perk up as the summer driving season in North America and sort of the Northern Hemisphere approaches. And that hasn't been the case this time around. And to me, it's hard to say exactly, but the trading positions, the paper positions in the futures market are very net short. And it would appear that the futures market is positioning itself for a pretty significant recession. Well, the equity market is not doing that. So it's one of these, we have a lot of conflicting signals today. But I think in the back half of the year, depending on what happens with the Strategic Petroleum Reserve, you should see the market tighten up from an inventory perspective, and hopefully that'll lead to at least stable prices. I think that there's a lot of downside priced in here today, and there could be upside depending on geopolitics and even just if demand surprises to the upside.
Do you like the energy producers right now from a valuation and opportunity point of view?
Yeah, so it's interesting, right? WTI is down 40% year over year, maybe a little more with the move below $70 today. But a company like C&Q, for instance, which we own for clients, is only down 5%. So what that shows you is that the producers are not really discounting what the oil price is discounting.
Right.
They also didn't run with the oil price to the extent of the upside last year. We're coming off some very high levels. But if you look at the securities, they're not cheap, they're not expensive. I think there's still, especially for the Canadian producers with a low 70 cent Canadian dollar, the future returns, even just at the strip, are pretty attractive. Remember, we're still dealing with oil prices at $68 that are well over 85 Canadian.
We hear so much about the disconnect between supply and demand in this commodity. What would it take to spur a rally?
Well, that's the funny thing, is that there actually isn't that much of a disconnect between supply and demand. I mean, we're talking about what is projected into the back half of the year, a supply shortfall actually of about 1 to 3 million barrels a day. So it's pretty tightly balanced, and that does speak to the fact that a cut from Saudi Arabia of now 2 million barrels a day unilaterally in the past, call it 6 months, should be enough to tighten the market. But like I said, the Wall Street trading community or the oil trading community is not buying that. And so, again, for me, we've been talking about the fear of a recession for some time. The recession is very fashionably late at this point. It's the best advertised recession that hasn't arrived. But there are a lot of signals out there, and oil, you sort of look no further than oil, which is sort of the lifeblood of the economic system, is telling you something.